Hey everybody, John King, Summit Funding. Thank you so much for joining me today for my Financial Friday. Every single Friday we come to you, except last Friday we had a technical difficulty, but every Friday we come to you with a financial nugget, some information to help you planning your finances, help you kind of just learning things that you need to know to run your financial world. So we range from like today's topic, we're going to be talking about the economy, we talk about mortgage related things, and we talk about financial lessons that you should have learned in school. And next week, we're going to be doing kind of a combination of both. So we're going to do financial lessons you should have learned in school, but really it's going to be about what is a mortgage. And we're going to explain how mortgages work. We're going to explain, what is the paperwork that you're signing? Because here's the truth. We all sign a whole bunch of paperwork when we get a mortgage, and you have no idea what it was that you signed. You don't know what the deed of trust is or what it means. You have no idea how to really think about your mortgage and what the paperwork really does. So we're going to spend some time next Friday talking about that. So if you're a homeowner and you want to know what the heck did I get myself into, or if you're thinking about being a homeowner, it's a great opportunity for you to educate yourself on what are the moving parts behind the scenes on how a mortgage actually works. So that'll be next Friday. Today, I am going to be talking about what the heck is going on with the economy. And it's funny, I've done this 3 or 4 times in the last year, and I usually do a lot of PowerPoint slides or graphs or charts. And I've got some of those that I might pull up. But the truth is, I want to have a dialogue. I want to have a conversation. So there's about 5 or 6 of you on right now. As people continue to join, I would love to, I'll encourage you guys who are watching live, give me your thoughts, give me your fears, give me your concerns. I want to know what you're thinking. What are you hearing from your family and your friends? If you're in the industry, what are you hearing from your clients and your colleagues? I want to address really what are your concerns, and I want to give you my thoughts. And I'm going to share a lot more from a dialogue perspective today than from a statistical perspective. Here's why. Because when you're sitting at the dinner table and your sister says, you know what, I'm worried. I'm worried about the markets. I'm worried about the economy. I'm worried about blankety blank. You're not going to pull out a statistic. You're not going to pull out a chart. You're going to talk to them like they're a human being. And my goal today is to talk to you like you're a human being, to share with you a little bit about how I think about these things and how I share these things with the people that I know and like and trust and love. And I want to share that with you today as well. So I'm going to start with the biggest buzzword that's going around right now, which is recession. Everybody's saying, oh my gosh, we're in a recession. Or they're saying we're going to be in a recession, or I'm afraid of a recession, or what the heck is a recession? So let's start with that. The technical definition I'll get into, but I want to talk first about what really is a recession. A recession is just everything slowing down, and it's the opposite of expansion. So what you have to understand, I think the old saying is if you're not growing, you're dying, or something like that. It's kind of the same concept. A recession is just the opposite of when the economy is growing. And when you think about cycles and you think about just business and the economy, every person who produces anything in this country is part of our what's called gross domestic product. And what that really means is, hey, if you add up every dollar that every real estate agent earned, every dollar that every car salesperson sold in cars that were sold, every dollar of goods that were manufactured by a particular manufacturer, all of these things that are done within the United States, that is called the gross domestic product, or the productivity of the United States. And either we are being more productive or less. It's that simple. It's impossible to be exactly flat. Now, we can be approximately flat. The economy can be sputtering, is what they would say. But typically, when you're talking about a recession, it is literally the opposite of expansion. And so an expansion period is typically longer, and the economy is increasing. We are producing more jobs. We're producing more goods, and we're producing more services. A recession simply means we're producing less this year than last year. We're producing less this quarter than last quarter. So is that the end of the world? Well, here's what it really ultimately comes down to. It comes down to how many people can stay employed. And the sad truth is we're dealing with this in the mortgage industry right now. We have been going through in the mortgage industry for the last 9 months a mortgage recession. Now, I'm taking the global idea of a recession and putting it on one industry, but the concept makes perfect sense. Look, we did $4.5 trillion in mortgages in 2021. And we're projected to do about $2.5 trillion in mortgages in 2022. That's almost half of the productivity. That's almost half of the business that is going to be done. And so we can't afford to employ the same number of people we employed before. It's sad. It's people's jobs. It's people's livelihoods. This is obviously what a recession is all about, is businesses are going to produce less goods and services, and therefore they need less people to do that job. In the mortgage industry, we're laying off a lot of people, a lot of really good people. And it's really, really sad. And at some point in the future, we're going to be busy again and we're going to hire a lot of people. And in the meantime, there are good people who have lost or unfortunately may still in the future lose their job, even though they're really, really good at what they do. That's a recession. That's what we're worried about on a national level, is we're worried about how deep is the recession? How bad is it? You've heard stories about mortgage industries laying off. If you haven't heard stories, I'll tell you right now. Laying off people since December of 2021 is when the layoff started. And Loan Depot announced a huge workforce reduction, that they're going to be laying off a significant number of people between this summer and next spring. So they basically said, hey, we're going to reduce our workforce. I think like half of their workforce, if I'm not mistaken. Don't quote me on that. But that is what's happening in the mortgage space. And that would be a deep recession. Okay. The mortgage industry is experiencing a deep recession right now. The fact is, some businesses will go under. Some mortgage companies will go under. Same thing in a normal recession. Some businesses are going to go out of business. Some businesses aren't going to survive. Some industries aren't going to survive a recession. So when you think about what the heck is a recession, I think that just relating it to a simple story about a simple industry like the mortgage industry, it gives you a very relatable way to look at it. There aren't as many mortgages being done. We don't have as need for as many people, and the industry itself will change during that recession. But there's opportunities for people, even if you're somebody who lost a job. The truth is, there are people who are finding jobs that used to be in the mortgage industry that are finding careers in other industries. I had somebody leave my team. Actually, I'll give her a plug right now. So she was not part of the layoffs, but she left my team, Carmen Gutierrez, working for me for 5+ years, ended up leaving my team early last year. And she ended up opening up her own business. And she does charcuterie boards. I think I said that right. Charcuterie boards. Yeah. Okay. Anyway, she does charcuterie boards and she's doing an amazing job and she loves it. She did it as a part-time gig. And the truth is, sometimes there's opportunity in despair. And for some people that doesn't happen and there's not opportunity. And so I'm not saying this is a good thing, but what I'm saying is a recession is likely to be happening in the near future. And there's a lot of people that will argue you're in a recession right now. The technical definition of a recession is 2 consecutive quarters where the economy shrunk, where we produced less goods and services than we did in the prior year. Well, guess what? That's officially happened. We had a reduction in gross domestic product in the first quarter of 2022 and again in the second quarter of 2022. But we're not shrinking jobs. So there's a bit of an argument going on right now saying, are we really in a recession? So this is great fodder for the next time that you're at the dining room table with somebody that wants to argue about economics and ask them, what's your opinion? Are we in a recession or not? Technically, the rule says we're in a recession. But the rule was kind of a rule of thumb. There's actually a division within the federal government that looks at it more holistically. They look at it and say, what's really the outcome? Yes, technically, this is, something bad has happened. Technically, we've lost productivity. But there's little things that can cause that to technically be true, but the big picture doesn't match what you're seeing in numbers. And that's what we're dealing with right now. In my opinion, we're not in a recession. Because a recession, the biggest impact of a recession is job loss, which means unemployment will go up. And we're not experiencing job loss right now. And that's a huge piece to understand when you're thinking about the economy and you're thinking about what's going on. One of the things to pay attention to is unemployment. And the unemployment rate spiked in March of 2020, and it continued to be rocky for unemployment in the first few months of in the first few months of the pandemic. And then everything got normalized and unemployment went back down. And we saw a huge spike and a huge drop back down, and we're at historically low unemployment, which means that everybody who wants to work can. Okay, that's the key. Everybody who wants to work. There's a lot of people who gave up and said, I don't want to work. So when you think about the economy and the markets, you've got to recognize that all the numbers are skewed. All the numbers are based upon what the people who created the rules say, well, yeah, but those people don't count because they've decided that they don't want to look for work. Well, if you've been unemployed for 2 years and you decide, you know what, I'm just going to stay home and take care of my kids, are you no longer unemployed? I mean, there's an argument that says, no, you're not unemployed. You're staying home and taking care of your kids. But was that by choice or was that by necessity? Because at a certain point, you can't afford to pay for daycare. So it's something really important to understand about the numbers. But the truth is, statistically and realistically, we haven't seen a big spike in unemployment. We've seen some, obviously, industries like the mortgage industry spike in unemployment. We've seen some industries start doing some hiring freezes, but we haven't seen a big change in employment. What we're dealing with is inflation. But before I get to inflation, I want to give you one last thought about a recession. For those of you who are business owners, this applies very, very directly to you. If you're an employee working for someone else, there's a little bit of a spin on this, but it's not written directly to you. But Walt Disney said at one point, hey, I heard there was going to be a recession. I've decided not to participate. If you're a business owner, think about that for a minute. Your business is very, very small part of the economy. So if the economy is shrinking, you have a choice. You have a choice to say, well, I'm a victim of my circumstances and I'm going to shrink too. Or you can choose to say, you know what, I'm going to change and I'm going to actually grow my business and capture opportunity. Because right now people are super scared. And Warren Buffett said at one point that, and I'll actually have the Warren Buffett quote here somewhere. He said, be fearful when others are greedy and be greedy when others are fearful. I'm not sure I love the greedy part, but it's logical. And it says right now in a recession, a lot of people are fearful. And what Walt Disney said is, hey, you know what? I'm not going to participate. Now, I don't know if I'm going to say that it's appropriate for him to have been greedy, but he's looking for opportunity. And if you are self-employed, you've got a lot of your peers that are being fearful, that are saying, hey, I better not spend money on advertising. I better not spend money on promoting my business or growing my business because it's going to be a waste. Everything is going downhill. And it becomes a self-fulfilling prophecy. So if I was talking to you around the dinner table and you were owning a business and you're asking me what I think about the economy, I would be simply very direct. And I would say, are we talking about the United States economy or my personal economy? Because one is not directly related to the other. You have to choose what you let impact your economy. Now, if you're an employee of someone else, you don't have that choice directly, but you do. Here's the truth. Every industry is going to survive. You have to figure out if your industry is going to go through a downturn, if your industry is going to be negatively impacted by the recession, then you have to decide, how do I make myself the most valuable person in my company, on my team, doing my job? That's where you get to decide, I'm not going to participate in the recession. I'm not going to let my family be impacted by the fact that, hey, the global picture of the United States is shrinking and some people are going to lose their job. I'm going to give you a statistic here. Unemployment right now is around 3.5%. High unemployment is 10+%, 10 to 12%. Let's pretend we got to 15% unemployment. That would be crazy. That means 15% of the people in the United States who want to work can't find a job. But guess what it means? That 85% of the people in the United States that want to work have a job. So you just need to make sure you're one of those 85% of the people. I feel very, very bad, and I don't mean to be taking a lighter look at or disrespecting the people that aren't working or will lose their jobs, because I feel horrible for them. But I also recognize that we can't live in the woes of the world. We have to live in the moment of what we're dealing with and what our world requires. And so if you own a business, decide not to participate. Decide to invest in your business. Here's the interesting thing. In a recession, when everybody else's business is dropping, if yours stays flat, that's a win. It means you're picking up market share. And if you are an employee of somebody else's business, then make the decision to say, I'm going to be the most valuable person in my job. It is not about what is in my job description. It's not about what am I supposed to be doing, but how can I make myself so useful that if we have to shrink the size of the team, there's no way that they're going to get rid of me, because I'm going to be able to help pick up other people's jobs. I'm cross-training myself. Think about the economy. Big picture is fine, but think about your personal economy and how to make sure that you don't let your personal economy be negatively impacted by the global economy and where things are going. So make that decision that says, I'm just not going to participate. All right, guys, we got about 10 people on here right now. Appreciate that we've got more people that are coming on. If you have questions about the economy, ask me. This is going to be a dialogue. I'm monologuing now, but I'm not going to do a lot of charts and statistics. I'm going to do a lot of conversational. What do we talk about around the dinner table about what's going on with the economy? So I'm going to switch gears now, and I'm going to talk about inflation. Inflation is a big word. Inflation's a scary word. Inflation's a buzzword. But inflation is really a normal thing. Okay, the prices for everything. Inflation is the increase in the cost of goods or services. And inflation is a normal function of the economy. It's a normal function of economics that, hey, you wouldn't work for someone for let's say that you started working, I don't know, when I started working, minimum wage was $5 an hour. And if I was on that job since I got my first job and I stayed working for the same company, would I be happy if they never gave me a raise in pay? No. There's kind of an expected, hey, I've grown in my abilities, I've grown in my knowledge, and I expect to get paid more. There's also kind of just a, hey, competition. There's other people that you could hire that could hire me. And so if you don't appreciate me enough, now this may sound for employers, it's like, well, wait a second, I'm writing you a paycheck, I'm giving you a job, that shows appreciation. But the truth is, employees need more than just their basic needs met. And they need to feel cared for and feel appreciated. And a pay raise is part of that process. It's part of them feeling like, I'm a valued member of this business. And so you wouldn't work for the same job without ever getting a pay raise. And nobody's going to do that. Well, how do you pay for those pay raises? You have to raise the cost of the services you're providing. It's that simple. So inflation is normal. Don't freak out about inflation. What's happening is inflation is getting higher, significantly higher than what inflation has been previously. Is that a bad thing? Absolutely. Inflation can cause major problems because it's actually much simpler than what you think. Most people are worried about, oh my gosh, I won't be able to afford to buy bread. Actually, you'll be able to afford to buy bread just fine, because you are going to end up demanding more wages from your employer. Now think about that. You're saying, wait, John, I don't have that control. No, you do. You do. Everybody will do it, because if inflation continues persisting the way that it is, employees are all going to be thinking the same thing, which is, look, I can't do this job anymore for $20 an hour. I need at least $25 an hour in order to pay for where inflation is going. That's the key. It's not about where inflation is. It is the worry about inflation is not what's been happening. It's people's expectation of what's going to happen. Okay. And if everybody expects inflation to continue going up, then they're going to demand more pay. And when they demand more pay, what's the employer's option? If every one of your employees comes to you and says, hey, I'm not going to do my job anymore for $20 an hour, I want 25. Well, you can let them all go and go start over from scratch, but you're not going to do that. So you're going to give them a pay raise. But the only way you can afford to pay them the higher wages is to raise the prices you're charging on the goods and services you're providing. And then the employer gets worried and says, I'm worried that my next group of people next year are going to ask for even bigger pay raises. I better raise the price of my goods and services even higher so that I've got a bigger cushion to afford more pay raises down the road. And it creates a spiral effect. That's actually the biggest challenge with inflation. Okay. People's earnings have continued to go up, especially over the last 15 years. Since the Great Recession in 2008, we've seen earnings go up significantly, but inflation, the cost of goods, stayed pretty flat. So we've been fat and happy. Hate to say it that way. Maybe that's not an appropriate term, but we've been fat and happy. I've had clients coming into my office on a regular basis. I still have them right now coming into my office saying, hey, John, I want to be able to afford my mortgage on one salary. Okay, but they have two. Like, it's both people are working, and their fear, this is the opposite of the fear of inflation. Actually, it's directly the fear of inflation. Their fear of things costing too much over time have them saying, you know what, I'm unwilling to commit myself to a higher mortgage payment. One may say that's a good thing. The problem is you miss out on opportunity. I had people in 2015 and 16 telling me that and saying, hey, prices are just going up so much. I'm not going to buy because I want to make sure that I can afford to pay my mortgage payment on one salary just in case one of us loses a job. Well, the problem is they missed out on all the appreciation that's happened in the last 7 years. They missed out on the biggest 2-year appreciation we've had in decades from 2020 to 2021. We went up 36% nationally in home prices. But people talked themselves out of that because they were trying to be proactive and be conservative. And there's conservative and then there's too conservative. And that's part of what inflation is causing is as inflation starts to go up, gang, we can still afford it. I'm talking about globally. I'm talking about, there are people right now who are struggling because of inflation. There are people right now who are having a hard time paying for gas, hard time paying for groceries because prices have gone up. But as a society, we can afford the inflation that we're dealing with. We're just not used to it. We're used to inflation being super low. It's been below normal. The Federal Reserve decided, now you can argue with me and say the Federal Reserve, well, who says they're in charge, or who decided that they're the smartest people in the room? Well, I guess they did. The Federal Reserve has said for years their target for inflation is 2%, and we've been well below that. Prices have not been going up enough, and it has been a concern. So they want some healthy inflation. Our inflation has been too low. We're now catching up. But the problem is that you've got the fear of, oh my gosh, I've gotten so used to being able to live on such a small amount of a grocery budget, and I could save a whole bunch of money. Saving's great. Or I could spend a whole bunch of money going out and traveling to Las Vegas every other weekend and blowing money on the gambling tables. Well, not so great, but you're used to it. And once you're used to it, you expect that pattern to continue. It's those things that need to change. So what is happening with inflation? It's still growing. I think we're going to continue to see high inflation, and the Fed is super, super focused on lowering inflation. Okay. How's the Fed doing that? By raising interest rates. When the Fed raises interest rates, what they're doing is they're trying to stop the economy from spending money. When you have to pay 20% interest on your credit card instead of 15%, you're going to think twice about buying that television from Best Buy, which means in turn, Best Buy is going to have fewer televisions sold, and they're going to have to lower the price of televisions in order to move their inventory, and that is going to slow down inflation. But Best Buy ultimately is going to have to lay somebody off because they didn't sell as many televisions. And that's when we start getting into a recession. That's where we start, we fix inflation, but we create a different problem. Think about, unfortunately, we have wildfires happening right now. They're horrible. And I'm actually not going to, I'm going to shift a little bit because I don't even want to go down the road of wildfires, but a house fire. If there's a house on fire and the fire department shows up, they're going to solve your problem by creating another problem. Think about that for a minute. They're going to solve your problem, but they're going to create another problem. How? Well, first of all, if it's a small fire that's inside of the walls of your home, they're going to tear the walls apart in order to put out the fire. And then they're going to use water which means that you've just flooded all the floors. And if it was on an upper story, then you flooded the upper floor and the lower floor of your home. You've ruined your carpets. You've got to repaint. You've got walls that have been torn apart. But guess what? The fire department has a singular job, which is the number one emergency is to put out the fire, or you won't have a home. And you don't care if you have flooding or not, because at least you have a home to fix the flooding problems. But to solve one problem, the fire department is creating two other problems. They are damaging your home by tearing apart the walls, and they're damaging your home by flooding it with water. And you thank them for doing that. That's what we're dealing with right now with the Fed. So who is the Fed and what are they doing? Why do they matter? And how are they impacting inflation? The Fed is the fire department in charge of making sure two things are under control. They're in charge of making sure inflation doesn't go too high, and they're in charge of making sure unemployment doesn't go too high. So sometimes they have to pick between those two things that they're in charge of, and right now is one of those times. The Federal Reserve today, first of all, the Federal Reserve is really made up of multiple federal banks that come together, and they meet on every 6-week basis, and they discuss policy. And there's certain bankers, they rotate which ones are in charge of voting in certain policies, and some of them are not voting members each year. And the truth is, all you need to know is that these are appointed officials that run a federal bank in a particular geographic part of the United States, and they all come together and they make policy decisions about money. And what they control most specifically is the interest rate that banks pay when they borrow money from the Federal Reserve overnight. Because a bank literally takes in your deposits, they loan them out to somebody else, and they wait until that money is paid back. They don't sit there on your cash, holding on to your cash. So what happens is at the end of the day, they might not have enough money to finish out the day. They could be in a position where, hey, we got a bit of a problem here, Mr. Federal Government. I've just brought in $1 million of deposits today, but I've had $500,000 worth of withdrawals and $750,000 worth of new loans. So I'm short 250 grand. Can you spot me some money until tomorrow when more people pay back their loans and more people put in some deposits? And the federal government loans them money to get them through to the next day. That happens every single day. Sometimes banks have excess money that they turn around and loan to other banks saying, hey, I got an extra $25 million here. I'll loan it to you until tomorrow, and you just pay me a really small percentage. That small percentage is called the prime rate. That is the rate that the federal government, actually it's the discount rate, the Fed funds rate, but it's the rate that the federal government sets for banks to charge each other, or the government charges for a one-day loan. But the bank can use that lever. The Federal Reserve can use that lever to impact inflation. And that's what they've been doing. So what are they doing with interest rates? They are significantly increasing interest rates because they're trying to put out the fire of inflation. There is an inferno going on right now with inflation. And I said earlier, it's about the concern that inflation is never going to stop. And that's what the Fed has to get ahead of. But the problem is the Fed is slowing down the economy in the process. And they're highly likely, I can't see any situation in which they're not going to put us into a recession. And so what's going to happen is we're going to see short-term interest rates go up. That means that your rates on your credit cards, your rates on your car loans, your rates on your home equity lines of credit, those are going up. If they haven't gone up already, they're in the process of going up. Depends on whether you have a variable or a fixed rate. But when you get a new one, it's going to cost you more if you have a fixed rate. If you have a variable rate, it's already gone up. So what they're doing is they're raising short-term rates, but that doesn't impact long-term mortgage rates. The Fed does not control mortgage rates. The mortgage world is worried about inflation, and that's what is causing mortgage rates to go up, is because of inflation. And the mortgage world is in part concerned about what the Fed is thinking and where the Fed is going to go with their policies, because the Fed also is able to actually spend some of the money from the Treasury buying mortgages. So that's where the Fed does now control mortgage rates, because the Feds buy mortgages. They're an investor in mortgages, and they go to the market, the mortgage market, and they say, hey, I'd like to buy some mortgages, and they'll buy them pretty cheap. Well, now if the Fed's not buying them cheap, other people are saying, well, wait a second. If the Fed doesn't want mortgages, then why do I want them? Think about that for a minute. The Fed was a buyer of mortgages. If they've stopped buying mortgages, then the other buyers are saying, man, I don't want to be stuck holding the bag if the Fed's worried. So they're worried about what the Fed is thinking. That's what all of this is about, is just psychology and what people are thinking. So the Fed is raising interest rates. And how are they going to impact you? The truth is, it is going to lead us into a recession. Now, here's the key about a recession. Every recession in the past, interest rates have been lower at the end of the recession than they were at the beginning. How in the world is that true, John? It's true because the federal government has to solve their not federal government, the Federal Reserve. They have the one mandate that they have to keep inflation under control. The second mandate is they have to keep employment under control. So if you were in charge of the Federal Reserve and you said, look, I'm worried right now, they are worried right now, that if I raise rates too high, I'm going to cause companies to stop expanding. They're not going to build new factories, and then they're going to start laying off employees, and we're going to have an unemployment problem. But if I don't raise rates, we're already in the middle of an inflation problem, and it's going to keep getting out of control a lot. And so the Fed has made it clear, we're going to keep raising rates for as long as we need to. And they actually had some comments this morning. Bullard, one of the federal chair people, one of the Federal Reserve members, was talking this morning and said, you know what? We're going to raise rates really aggressively right now while unemployment is still low. We believe that the economy can suffer a punch. And so we're going to punch it really hard in the gut. We're going to throw everything we have at it because we think the economy is pretty resilient. In other words, they're saying, look, I've got a super strong adversary here. And yeah, I think I'm going to cause them some pretty big problems. I'm going to put him in a coma. But don't worry, it's only a 20-year-old healthy guy. He'll come out of the coma just fine and have not many after effects. That's kind of what the government's saying right now. And I kind of agree with them. We have to solve the inflation problem because in the 1970s, we didn't. In the 1970s, we had a federal government that was wishy-washy, that said, well, inflation's high, but I'll raise rates a little bit and see what happens. And well, that's helping a little bit. So let's pull back. Because I'm worried about unemployment and we can't let unemployment go high. And so they ended up being wishy-washy and going back and forth. And it created something called stagflation, which means that what they were trying to prevent was high inflation. They were also trying to prevent high unemployment, but they ended up having both. They had a stagnant economy, which normally means you don't have inflation, but they had inflation at the same time. It was the worst possible outcome, and it's because we had an indecisive federal government. That would be a major problem if we allowed that to happen. So the Fed has made it clear, we're not going to let that happen, and we want to keep reminding everybody. We want to remind the mortgage world. We want to remind the stock market, we are not done raising rates because we know we haven't put out the fire yet. And we know we're going to have a problem with the flood later. We know we're going to have a problem with all of the walls that we've damaged. But guess what? If we let this fire get out of control again, there's no house to worry about flood issues. There's no house to worry about damage. The fire has to get put out. Inflation has to get put out. So those rate increases are going to continue to impact you. So my personal plug, I'll tell you, is if you have a lot of unsecured debt, a lot of credit card debt, a lot of car loans or other unsecured debt, your interest rates are moving up. You might want to look at tapping into some of your equity because even though mortgage rates are high, mortgage rates are a tax write-off. So you get to have savings on your taxes. And the kind of funny thing is the higher the interest rate, the more you paid in interest and the more of a tax write-off that you get. And you get to spread that debt out over a longer period of time. And now when things get better and interest rates go down, you can then lower the interest rate on that, but shorten the term. So the key to real success long-term coming out of this cycle, if you're a homeowner, is to figure out how do you solve your short-term cash flow issue if you have one. And one tool is to consolidate your debt. But then when interest rates go back down in a couple of years, again, I'm not predicting a guarantee. I'm just telling you what I expect. We're going to be in a recession sometime in the next year or so. And sometime in the next 2 years, we're going to see mortgage rates come back down. When they do, you refinance to lower your rate, but you put it instead maybe on a 15-year loan instead of a 30. You'd have exactly the same payment you have right now because you're paying a whole lot less to interest and more of that same payment's going towards principal. That's the strategy that's going to get you succeeding through this recession and out the other side in a positive way. So should I be worried about my job? The truth is, that's something I talked about earlier about making yourself the most valuable person on your team. I strongly believe that we are going to be in a recession and that we're going to see job losses. We're going to see, an additional 5 to 10% of people that are currently employed lose their job. Now, remember, that means 90 to 95% of you are going to keep your job, but it means that 5 to 10% of you are going to lose your job. So you should be worried in a positive way. Worrying about things you can't change is stress. Worrying about things you can change is channeled into positive energy. So when I think about the economy, I think about my personal economy, I think about your personal economy. Yeah, I would be worried about my job, but not in a negative, stressful way. I'd be worried in a positive way of saying, how do I make myself the most valuable? How do I make sure that I'm in a position that is in demand? Do I need right now to go get additional certifications or training in my job to make sure that I'm the most valuable I can be? Now would be the time to double down on that. Before we're in the recession, before the cuts really have to start getting made, now is the time for you to make that decision to say, how do I make myself more valuable? But here's the other side. Don't over improve yourself. So I'm going to relate this to real estate for a quick moment. There's a concept of you don't ever want to be the biggest home in a neighborhood or the smallest home in the neighborhood, because people look for a particular type of home in that neighborhood and they expect a particular type of home in that neighborhood. So if you build too big of a home, it might be a beautiful home, but nobody wants that nice of a home in that particular neighborhood. You've over improved it. As an employee, you can almost price yourself out. If you are the highest paid person in your job, you may be really good at it, but in a recession, sometimes that's the person that needs to go, because that's one person working 40 hours and yeah, they're super valuable, but I could have two people working 80 hours and they could get more done in those 80 hours than the one person could in 40. So make sure that if you're in a position where you've overqualified yourself and you're the highest paid in the job, I'd think about what shifts I can make. What moves can I make into a different role in the company that I'm more middle of the road in the compensation model? It's just a sad reality of what employers look at when they're looking at letting people go. Figure out where you fit into that model and make sure you're not the highest paid in your role, or you run the risk that, hey, you might be one of the ones that's let go first simply because they could save 2 other jobs by letting you go. So not what you want to hear, but it is the truth about what I think, and it's what I would say around the kitchen table as I'm talking to my friends and family about what I see happening in the economy. This is a question I get a fair amount. John, is it a good time to be investing? Well, it goes back to what Warren Buffett said, and I'll bring that up again. I know I brought it up earlier. Warren Buffett said, be fearful when others are greedy, be greedy when others are fearful. And Warren Buffett has been one of the best investors in really recent history, modern history. And Warren Buffett has built his entire portfolio on this thinking. Right now, everybody is scared. Right now, the stock market is challenged. The stock market is falling. It's not performing as well. And people are like, see, that's why I shouldn't be buying in the stock market, because see how bad it is? But those same people, when the stock market was at its peak, said, oh, man, I shouldn't buy because the prices are too high. It's no different than buying a home. It's no different. As a matter of fact, I'll talk about it in a minute, but I'm going to say it now anyway. People are saying the same thing right now about home ownership. And 2 years ago, they're like, oh my God, I'd love to buy a home, but prices are just too high. And now prices are starting to come down. People are saying, hey, I'd love to buy a home, but I can't get a seller to help me be willing to sell me their house or be willing to help me with closing costs. Well, now sellers are willing to help you with closing costs. There isn't as much competition. But now you're like, oh man, well, then I don't know if I want to own a home because prices are going to fall. And then later on, when prices are going up, you're like, oh my gosh, I missed the boat. I should have bought back then. You just have to make a decision to get on the elevator. The elevator is going to go up and down, but you have to jump on the elevator. So decide if it's the right thing for you. What you're looking at is when you think about investing and you think about the market, and everybody right now is worried, to me, now is the time to do something called dollar cost averaging. And it simply says, pick a dollar amount. How much money can I afford to put into the stock market every month? Maybe it's $150. But guess what? You spend $150 every single month. So no matter what, if the prices go up in the stock market, then you're happy you bought low. If the price drops, then when you buy next, you're buying more shares. You're getting them at a discount. So if you just buy and you put a little bit of money into every single month, this is the time to start doing that. If you're not doing it already, you're not trying to time the market. You're not trying to find the low and throw all your money in. You're simply layering in a little bit of money every single month, and it will self-correct, because no matter where you buy it at, your average price is going to be dead center of that, and you'll become the smartest person around because you didn't try and time the market. But people are afraid to do that right now, and like Warren Buffett said, be greedy when people are fearful. All right, this is a big one. What is happening in the housing market? So let's be clear. The housing market is definitely experiencing a pullback. You can ask 20 people and you're going to get 20 different answers on what is really happening, because nobody knows, not even me. But I have a lot of knowledge and statistical data that I look at. I have a lot of experience. So I'm going to tell you a couple of things about the housing market. First of all, it is not going to be a repeat of 2008, in my opinion. 2008 happened because we had a glut of people with mortgages that had adjustable interest rates, and their payments were going to adjust. Now, we had a recession in 2008. Some people lost their jobs, and those people couldn't afford to make their payment. That's going to happen again. We're going to hit a recession. Some people are going to lose their jobs, and they're not going to be able to afford to make their payment. Some of those people that can't afford to make their payment are going to sell their home because they have equity. Some of them are going to let it go to foreclosure. The same thing happened in 2008 that's going to happen coming up, is that you're going to have people who lose their job, can't afford to make their payment, and they have to sell their home or they have to give their house up as a foreclosure. That is going to happen again. But what happened after that in 2008 is what won't repeat. Because in 2008, you had the neighbor that had a job, could afford their payment without a problem, didn't lose their job. The problem is their payment was skyrocketing next month. They just got a letter in the mail that said, hey, your interest rate's going from 5% to 9%, and your payment's going from $1,500 to $2,500. I don't know about you, but if I've been affording a $1,500 a month payment and I got a letter saying it's going to $2,500, I've got a problem. So for a lot of people, okay, fine, I'll just refinance the loan. The problem is that the housing price had dropped just enough that they didn't have enough equity to qualify for a refinance. And so therefore, they didn't have an option to keep their home because they couldn't afford the $1,000 higher payment, and they lost their home, which caused housing prices to drop a little bit more, so that the next guy experienced the same increase in monthly payment on his mortgage statement, and he didn't have enough equity to refinance. And that was the domino effect that kept driving prices lower and causing every neighbor to not be able to afford to refinance. It's not about everybody losing their job. Unemployment, recession doesn't mean everybody loses their job. 2008 was a domino effect. We don't have that today. A majority of people with mortgages right now have fixed rate mortgages. So some people are going to lose their home because they've lost their job. But the neighbor next door that has their job, their payment's never going to change. They're going to be able to keep their home. So we're not going to have that problem. So what is going to happen, John? Well, I don't know. But here's what I think is going to happen. I think that right now we're seeing a pullback in demand, but the demand is still there. How many people do you know right now who are saying, hey, I'm going to buy a house as soon as prices drop? Hey, I'm going to buy a house as soon as interest rates come down. All of those people know that they're going to buy. They just have a reason they're waiting for. Well, one of two things is going to happen. Either their reason is going to come true, or they're going to decide, or well, three things, I guess. The reason is going to come true, and they're going to buy. They're going to decide, hey, I've been waiting way too long, and this is silly. I shouldn't be waiting, and I'm missing out on all the opportunity in the meantime. So I'm going to buy anyway, even though my reasoning hasn't come true. Or they're going to be stubborn and sit on the sidelines. But I'm going to tell you, 2/3 of the people, they're going to end up buying. There's a huge amount of demand of people that want to buy. So if we see foreclosures coming on the market at any reasonably high pace, there's a bunch of people waiting to buy them. Those people are going to dive in and buy the homes. Think about the stories you hear on the news about gas and how a gas station accidentally put gas on sale for 65 cents instead of $6.50. They missed a decimal point. We all hear the stories, and everybody drives for miles around in order to get gas from there. Well, the truth is, unless you happen to be driving right down the street, right next door to that gas station when it happened, by the time you get there, there's a huge line of people. By the time you get to the front of the line of people, either the gas station has figured out the problem and they've changed the price back up, or the tanks have run out of gas and there's no more gas there for you to get. Either way, you're not getting gas at that price. Somebody did, but you're not. That's what's going to happen if housing prices do tank. If everybody at the same time says, I'm not buying, housing prices will tank. And then everybody's going to come around and they're going to jump in and want to buy homes. And some people are going to get homes cheap. But the next person that sells their home says, wait a second, there were 42 people trying to buy that house next door. I'm going to raise my price. Exactly what happened in 2020 and 2021 is going to happen again. Prices are going to fall super quick, which actually kind of happened in March of 2020. We had a pullback, we had some price concerns, and then immediately everybody jumped in. That's my prediction of what's going to happen. On top of that, interest rates are going to fall. So when I say, is this a good time to buy a home? I think it's a great time to buy a home as long as you plan on staying in the home for around 5 years or longer. If you expect to change jobs and relocate to Las Vegas in 2 years, it's a risky proposition because we don't know where things are going to go in the next 2 years. But if you're thinking I'm going to be in this home for 5 years or longer, it's a phenomenal time to buy because you have time to actually get inspections on the home. You have time to actually get and negotiate with a seller to actually get the deal that you want and make sure that you actually picked the right home instead of just the only home that somebody would allow you to buy. So it's a great opportunity to do that. Plus, when interest rates come back down and everybody else is in the feeding frenzy trying to get their offer accepted, you're working with me to lower your interest rate through a refinance. You get the best of both worlds. So I think that now is the perfect time to buy. The next question is it a good time to sell? Depends on what you're doing. If you're just speculating the market, you bought a house 15 years ago and you're speculating, you say, hey, you know what? Prices have gone up. Let's say you bought 10 years ago. Prices have gone up a lot. It was an investment property. I want to cash out my investment and get out of being in rentals. It's a great time to sell. If you're thinking, hey, you know what? I want to trade my house for another one and I want to be contingent on the sale of my home. It's also a great time to sell because it's easier to get contingencies approved. But just recognize there are way fewer willing buyers right now than sellers. So it is shifting pretty quickly. And in some places, I'd say that it is a balanced market, almost leaning towards a buyer's market. So if you're just testing the waters and you want to get, hey, I'll sell only if I can get this high price, don't bother. You're not going to get it. If you're realistic about your price, if you're realistic about looking forward instead of backwards, look at the future of where things are going and where prices are at in your neighborhood, you can sell your home, no problem. But if you're trying to get top dollar, it's not, you've missed that opportunity. And you might as well wait for a couple of years for interest rates to come back down. And then the feeding frenzy that I expect is going to be the perfect time for you to sell a home. So it really is about what your motivation is. But that comes to really one of my final points, which is, how do we know what the truth is, John? Should we believe the media? You know, I did a short video on this a couple of weeks ago, and it's been pretty popular about, is the media lying to you? Is the media lying to you? I don't know. It's fun for me to say it controversially and put it as a title of a video. Is the media lying to you? The media is lying to you. Well, the media's job is to sell advertising space. Media's job, print media, is to sell newspapers. Digital media is to sell views and clicks. And so the media's job is to get you to watch, to get you to listen. Are you going to listen if they say, hey, check out this article about how everything is really good and that everybody's going to be okay? No. But the article that sensationalizes the housing market is crashing. We have, foreclosures are up 100%. That actually might be true. Let me be really clear. I could absolutely see right now foreclosures up 100% as being a factual statement. But there's a key missing piece of information. What were foreclosures at before? If there was 2 foreclosures in all of the Central Valley, and now there's 4, foreclosures are up 100%. Foreclosures have doubled because 4 homes were foreclosed upon. Now, back in 2008, 40,000 homes were foreclosed upon. By the way, guys, I'm faking the numbers here. It's the theory I'm trying to explain. So when you have somebody who says, hey, oh my gosh, 47% of houses on the market have had a price decrease. Prices are falling. You have no idea how much they listed the home for. 72% of sellers are unrealistic in what they think they're going to sell their home for. Kind of saying that as a joke, but anybody can make a statistic. The sellers have had a hard time recently coming to terms with the fact that the housing market has shifted. And realtors are having a hard time explaining that to them and convincing them to sell at a lower price. So the sellers are putting the house on the market at a higher price. And it's not because the realtor isn't trying to do their job of convincing them prices have dropped, but it's the seller just isn't willing to believe it until they put the house on the market and they get no offers or even no showings for a couple of weeks. And they realize, maybe the professional that I hired to sell my house for me, maybe they knew something about what was going on in the market, and maybe I should have listened to them. And so the media says, oh my gosh, 42% of housing prices have had a price reduction. That is probably very, very true, but it's skewed because it doesn't mean that the market has dropped 42%. It doesn't even mean that 42% of homes have a lower value. It simply means that 42% of the homes on the market right now might have had a seller that had an unrealistic expectation of what houses are actually worth in today's markets. And then reality hit. They learned that they weren't going to have a unicorn showing up with a boatload of cash to buy their house for tens of thousands of dollars more than anybody else's. And so they lowered their price. The media looks at the statistics that are accurate, but paint the picture that they want to paint. We all do. Okay. It's a bias that we have. And no matter how unbiased you want to be, the truth is the media's bias is to sell advertising, is to make money. And so they're not going to lie to you, but they're not going to give you the full story, especially in the headline. But if you read the entire body of the paper, most of the stories are going to tell you more of the truth and explain it to you in a way that you can, if you really take the time to digest it, will understand that the headline had truth in it. But if you took the headline at face value, it's not the true story. You have to be super, super cautious. So I've got a couple minutes left. I've got about a dozen people on here right now. If you're watching recorded, please feel free to post any comments and I'll follow up with those afterwards. If you're watching live right now, I'd love to answer your questions. So what are your worries about the economy? What are you scared about? What are you hearing that maybe you showed up late and maybe I addressed it already and I'm happy to address it again? But I'd love to get comments from anybody if you choose to tell me kind of what are you seeing right now? What are you feeling right now? What are you hearing right now from your clients, your friends, and your family about the economy? And really, my question is, should you be scared? I think there's a lot of things to be scared of in life. I think that, the reality of life is that it's unknown. We don't know what's going to happen tomorrow. We don't know what's going to happen today. But what we do know is that there's certain things we can control and there's certain things that we can't. And so my best advice to you when you think about the economy is focus on the economy of me. Focus on what is it I can do to best shore up my personal economy. Make sure you got some money in savings. Make sure that you're paying down your high interest credit cards if you can. Make sure that you're doing what you need to do to prepare yourself. It does not mean be on defense. It doesn't mean be so conservative that you don't make smart decisions. But it means recognize what we're heading into. We are heading into a recession. We're heading into a time where more people are going to lose their jobs. And you have to figure out, what do I need to do to make sure that I'm not one of those people? If you just simply think about it from that perspective, it's not about being scared. It's not about being super conservative. It's about just making sure that you're taking little steps to defend your kingdom, defend your fiefdom against what you think can happen and what things may impact you through a recession. And then start thinking about, what can I do to improve my position coming out of this recession? How can I make financial moves? How can I make personal moves? How can I make business moves? What can I do? Because most great businesses are actually born out of recession. It's an opportunity where people go into hibernation and they hide and they are afraid. And if you choose to not be afraid and you choose instead to embrace the opportunity and to do something with this opportunity, you're going to come out way better on the other side. You just have to make the choice, instead of being scared, to be proactive. Gang, I really appreciate you coming and listening to me today. We talked about a lot of stuff. What I'll tell you, as I said earlier, is be fearful when others are greedy and be greedy when others are fearful. Again, I don't like the word greedy the way he said it, but I like the concept. Make a choice for what you need to do to grow yourself, to grow your business, to grow your life. And don't let what's happening with the economy scare you. I hope you appreciate that I didn't spend any time on charts and stuff, because really this was a conversation. This was a fireside chat, a conversation about what I think and what I talk to my most important and closest people in my life about what's happened with the economy and the advice that I'm giving them. And I would love it if you would share that advice with the people that are important to you. And don't forget to share me. So if you're not already a subscriber on my YouTube, please subscribe. If you are on my YouTube, please like and comment, because I really appreciate the feedback and knowing that you guys appreciate the information that I'm putting out there. So I hope you all have an absolutely amazing